Rồi đó, bắt đầu quay nha.
Nha. Khi nào bắt đầu thì nói em nha.
Bắt đầu rồi đó.
Hello everyone, my name is Ngọc Nguyễn and we are the Essential Footwear Company. We are going to talk about the operation of our company. Okay, first we would like to give a brief review of our financial performance from the year 2010 to the year 2020. The chart given here describes our annual total revenues over the last 10 years. The revenue of our company has grown gradually from nearly $500,000 in 2020 to approximately $1,250,000 in 2020. Although there was a slight decrease in 2019, our company was able to be back on track after that. The next chart describes the annual EPS of our company. It shows that although the EPS increased gradually in the few beginning years, it kind of fluctuated in the last 5 years. However, it is noticeable that our company is making more progress in the year 2020 when the EPS rise almost 2.5 times than the previous year. Going to the annual return on equity chart, it shows that our company is doing a great job in the first 3 years. However, since then, there was a significant decline from around 37% in 2013 to 18% in 2020. Next is our annual credit rating chart. In the first 3 years, the credit rating kind of fluctuated with P, A minus, A. However, beginning from the year 2013, we have been doing a great job in maintaining it as it's stable at A+. The next chart is the year-end stock price chart. The starting stock price of our company was quite low, which was around $30. There have been a lot of change in the stock price. However, the stock price in the current year is soaring, which is almost 4 times than the previous year. The last chart given here is the annual image rating. This chart demonstrates the image rating of our company. The image rating of our company experienced a significant growth in the first 3 years. Since then, it slightly decreased from 95 in 2013 to 87 in 2020. Up next, we are going to talk about our strategic vision. Our strategic vision statement is our company is setting to position our product to be of the global best cost, providing customer with the most value from the product they pay for. Our concentration will be on making investment into new technology that will significantly reduce our production cost per pair, which will eventually benefit our customer in return for having a better affordable price for our products. Over the years, we have established ourselves with a very strong financial condition that will let us sustainably grow in the future, creating more value for our customer without diluting our investor equity. Next, we are providing our target for the next 2 years. After experiencing a decline in business in 2014, we see an increase in the current year, and we believe that we are still moving forward in the next year. So the target for our company is to reach the EPS at 14 in 2021 and 15 in 2022. The return on equity will increase by 4% each year, reaching 38% in 2022. We also believe that we are able to maintain the credit rating at A+ in the future. And we also set the goal for image rating at 90 and 93 in 2021 and 2022, respectively. About the stock price, we believe that it is still soaring and be able to reach $300 in 2022. Up next, I will pass on to Hugh for the competitive strategy.
All right, thank you, Scout. So as we earlier mentioned, like our company is employing the overall low cost strategy globally. So we apply the same low cost strategy for all regions that we have, um, retail store and plans at. So in this strategy, we kind of try to focus on the lowest cost because low cost is the key to create the value for the product while providing the equivalent quality as the industry average, or we even sometimes provide offer more quality product compared to our rivals. And then we kind of present in the broad range of market assessment, which means we have product in kind of all kind of assessment that all the rivers having product in. So thanks to that, we kind of raise more brands awareness and reputation. Next, please. So first, let's take a look at our internet marketing competitive strategy. So for the internet market, we try to make the customer price expectations because we always maintain our retail price, under the average the industry average about $1 or $5. So we try to offer them, quality product while providing very affordable price. And for the internet market, we always try to increase the company reputation by increasing the celebrity endorsement over the years. Although like we kind of put a lot of money in there, but like due to the fact that we have kind of a lot of competitive in the later year uh, with celebrity endorsement, so we kind of lower the investment in celebrity endorsement because technically we just don't want to put like a huge chunk of money in there just for celebrity endorsement. And like celebrity is not the only way that we can raise the company awareness and reputation. That's why we also invest more money in search engine advertising, which is a very good tool for us to boost the sale on internet market. So we always try to maintain the high investment in search engine advertising. So which is our strategy. Like we try to keep our brand reputation pretty high and easy for everyone to recognize. And we try to alternate between celebrity endorsement and search engine of advertising because we believe that when we have one we don't really need the other one, but we try our best to provide the low cost. That's why we try to minimize the cost as much as possible. Next, please. And next, we'll take a look at the wholesale market. So for wholesale, our strategy is kind of similar. We're still trying to provide the same quality as the industry standard, but with the lower cost from $2 to $10 per pair. So we confident that we provide a quality products compared to our rivals. Um, and we also maintain the wholesale price at a cheaper cost that per pair from $2 to $10. And then one of the strategy that we kind of like leading the company toward is we try to make our companies easier to work with. So by having plants in all the region that other river have, so we try to expand our production plants in all regions. So customer and business partner can reach us more easily. And as the plan is by economy of scale, we believe that our cost will be very competitive because we have plans in all regions, and it could reduce a lot of unnecessary costs. And then also we also maintain the high brand reputation by investing in money in the brand advertising, and that would make our sale in the wholesale market increases over the year. So next, let's take a look at how we been doing for the last 10 years. Next, please. Okay, so let's take a look at the table. So you can see that, for internet marketing, um, we started, the sale is very modest numbers, like we started at 300, 200 per pair, in all regions. And at the end of the 10 years period, we can see that our SQ rating is, increases. Um, the number of pairs sold is also increasing. We start, like for example, in North America, we started at 353 pairs in year 10, and at the end of year 20, we was able to put on sale up to like almost 1158 thousand pair. So that could be a huge increase over the last 10 years. And it's kind of the same trend in other regions, because we kind of employ the same strategy for all regions. That's why we don't have that much difference between the regions, although we do have some kind of like fluctuations during the 10 years in origins, but we believe that overall we've been doing well. And because we increasing the sale, we trying to cut in the cost, and taking up more market share. So yeah, that's the plan for us over the last 10 years. And next, we'll take a look at um, you know the company image rating and net revenue. We already mentioned that earlier, but the thing is that we want to show how the company has been doing, because with our strategy, we believe that we've been doing good, because over the last 10 years we been increasing in both image rating and revenue. That's a very strong proof that we've been doing good, because as image rating rise, we have more sales and more profits uh, follow. So even though in the image rating we have some drop, because I earlier mentioned that we have a strong competition in the celebrity endorsement. So we trying to avoid that unnecessary competition by investing money in other mean of advertising to reduce our cost. Okay, and then next Juan will be talking about oh, we have one more, that's for the private label. So the company, we been we not really focuses on the private label at the beginning, because at the early stage we really believe that the company is very young, and then we don't have enough resources and like available workforce to produce private label production. That's why we have to wait until we have enough resources to start producing it at year 16. And then from there we will see that our company has been taking a large market share in uh, from year 16, because you know, like we start from zero in the earlier year, and then we take up to like 1/4 of the market share with other competitor that's already in there before. So you know, with the good strategy that we provide very low cost product with you know, the competitive product, we have a quality product, competitive price. So I think that's the reason why we can take up the large market share in a very short period of time. And I still believe that we're doing okay as long as our pricing strategy is still competitive, you know, compared to other rivals. Okay, thank you. And next one we'll be talking about other stuff. Okay, next, we have production strategy. So we build plans in our region to cut all the unnecessary costs, which is like shipping costs or you know, like other costs that we don't really need. And we keep plants capacity at the minimum required volume to produce both branded production and private label. And we tend to use overtime employees to produce private label orders, because we want to avoid unnecessary depreciation costs from the machine. You know, because if we have to buy new facility, we have to buy new spaces for it. And then, you know, for the production, private label production is would generate lower revenue, but it would require a lot of more resources. That's why we try to take full advantage of whatever the resources that we already have now, um, and you know, and try not to waste that. And next, we also trying to you know, while train our firm employee to reduce the rejected rate and improve the quality. And because we believe that you know, that would also cut the operating costs and, you know, unnecessary costs. Thank you.
Right. I will begin my part about to talk a little bit about the product positionings of some of our direct competitors and our products positionings in the marketplace. Um, it can be clearly seen in the pictures that our direct competitors would be company C and company B. If you go to the next slide, please. In the year of 19, it's very clear that our direct competitors is company C and B. Although company C is not really great, it's not that big in the internet segment, but overall, the company with B and C has the products that is the most similar to our company's product. So yeah, next slide, please. In this part, I would talk about our company's finance strategies, which will concern specifically toward our policies surrounding dividends, debt, equities, including stock issues and buybacks. And then finally will be about credit and image ratings. So we initially pursue a dividend policy from year 10 to year 14. We decided to increase our dividend per share from $1 per share to $1.0 per share during that period. We think that we were doing great during that period, and we think that it should be reasonable for us to share our earnings, our retained earnings, to our investors. But unfortunately, this turned out to be a mistake. Later on, we realized that our company were in a growing period, which required a significant amount of cash and capital for us to invest in expansions like facilities, factories, and production line. And this giving out dividend too early caused us to did not have enough capital to do so. So we need the money to significantly reduce our cost per unit in the future. So after the year 15, we decided to stop paying out dividend and keep the money that we made, retain them and reinvest them into our machines, factories, and then buy a new machine that has been fully depreciated in the year 15. So yeah, as I said before, we decided to stop to cut our dividends in year 15, and then we maintained that policy until the year 20. And instead of paying out dividend, we reinvested all the money, not all the money, but around 70 to 75% of the retained earnings back into the business. Uh, Next, so in terms of debt, we try to take on as little debt as possible. We wanted to keep our interest costs as low as possible to boost our earnings, and then and also to maintain a good image rating and a high credit ratings with a high interest coverage ratios. That is what we look into the financial ratios and financial reports to see our conditions of our balance sheets. So next, we also try to pursue a buyback policy at a constant rate annually, initially, of course, and avoid to dilute our investor positions as much as possible by not issuing any new shares. But then the turning point here is in the year 15, when we realized that we did not have enough money to replace our fully depreciated machines for productions. So what we did then is to issue 2,000 shares. Our share back then was around $100. So we get cash on hand for around $200,000, and we reinvested that back into our machines. But then in year 16, yeah, of course, it's kind of freaks out the investors. Our stock price kind of plummeted a little bit, but then it's all goes back to normal in year 17. So next slide, please. So for futures actions and strategies, as Hio mentioned before in his slides, our core strategy is to reduce our costs as much as possible in order to provide our customer with the best value for each dollar that they spend on us without shrinking our margin per unit. So that is a very ambitious strategy. Everyone can tell. But during the first 5 years, we had the best operating margin in the industries. We're very proud of that. However, our business was growing very, very fast during the first 4 years. And it appears that our business was overheated and we could not, our machines, our capital, our policy could not keep up with the increasing demands from our customers. And it was our fault to not act quick enough to expand our productions into other marketplace like in Europe, Asia, and also with the problem of paying dividend too early during that period. Like I said before, we lacked the capital to expand into new space, buying new equipment, expanding our inventory space, which made us did not have enough resources to produce the inventory that we want to meet the demand from our customers. So for that reason, we see a huge decline of our operation in the year 16. However, we adapt to that situation pretty quick, I would say, and we consistently remain in the top 3 firms that have the highest revenue. The only problem we had back then was we still have a pretty high distribution costs, and it's sad to say that we had the highest distribution costs in the industries, and we actually realized that. And what we did after that is to try to expand with the money we got from our investor in the year 16. We tried to expand our factories and production line into other places to reduce our distribution costs. And of course, I know that it was a little bit too late into the competitions. However, if the competition were to continue after year 20, we strongly believe that we are heading on the right track. And with our facilities and factories are fully set up in Europe, in Latin Americas, in Asia, um, our distribution costs and labor costs would be significantly reduced, which will maintain our edge on our operating margin. With our balance sheet remaining very strong, we are planning out to giving out dividends, and we actually give our dividend of $0.5 in year 20, and we're planning to increase that amount annually by an appropriate amount every year after year 20. So that is basically our plan for the futures. Next slide, please. And so after finishing the BSG project, here are some points that we've drawn out from the project. So the first is that for companies that is in the early stage of growing, such as our company, the company should not pay out too much dividend too early, like we did. Instead, we should keep the money and focus that retained earnings that we got to reinvest back into our factories, into our production line, into our facilities, and maintain our competitive advantage. Second, management team like us should not look for short-term earnings. Our mistake in the competition was to stretch too much on the first 4 years of the competitions and forgot about expanding in other places and maintain our competitiveness in the year afterwards. So what we recommend is for management team to look more long-term into the futures so the company can maintain its competitive edge over its competitors. Lastly, we have what we noticed during the competition is that the importance of marketing expense and marketing investment is tremendous. We see our demand for our products increase by long run with an increase in celebrity endorsement, marketing expense. So I would say for every company, no company should undermine the investment for marketing, and they should not back out on marketing expense, even if there are some hard periods, because it's going to cost them significantly on the demand of our customers. All right, that's pretty much wrapped up our presentations. Thank you for listening. I hope you all have a good day. Thank you.